You're watching Stock Watch. I'm Zanati Kuma, and joining me to unpack your stock-related questions today are Pierre Verster from Protea Capital Management and Roy Mutooni from Sanlam Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you for your time, gents. I actually want to start off with a question on the S&P 500. That hasn't really been doing well over the last few sessions. We also saw we're seeing a heavy knock on the NASDAQ today. Just actually starting off before we go into whether it is a buy or not. Roy, just starting with you. What is it that is bugging the U.S. markets lately? I mean, is it Nvidia? Is it something else?
No, I mean, clearly it's going to be around the Magnificent Seven. They've been going sideways and downwards for the past couple of weeks, and that has generally tended to move the markets down. I think what you're basically seeing here is the impact of, first of all, that market being quite expensive. And secondly, a bit of a recovery in Asian markets, particularly Chinese markets, Chinese tech, and Europe as well. So investors just basically look at it and say, the US has done really well. The macro picture in the US is a little bit uncertain right now. Whereas these other areas, what you're seeing is some positive news coming, very cheap valuations. The likelihood of them going any lower is quite low. So a bit of a rotation then. I think that's the main thing. You can't expect these Mag 7 stocks to keep shooting the lights out. And from a valuation perspective, there is no doubt that the valuations are stretched. So it's more rotation than anything else in my view.
Yeah, well, there's the question here that's asking if the S&P 500 is a good buy. Of course, we've seen this pressure. Do you think that, JP, this could be a buying opportunity, or is it signaling something that could be a little bit of a worry, particularly ahead of the Nvidia results tomorrow?
Yeah, so it probably depends on your timeline, your investment horizons, Zanati. I think in the short term, I wouldn't be a buyer of the S&P 500, as Roy has correctly said. If you look at the main constituents, especially the Magnificent Seven, the valuations are stretched. But the wonderful thing about passive investing and the way that the S&P 500 works is, as those very expensive stocks maybe become less expensive because their share prices drop, they become a smaller weight in the S&P 500. And the new upcoming companies, tomorrow's winners, that start rising in share price, they become a bigger weight in the S&P 500. And that is the strength of a passive investment in strategy. And that's what makes it so hard for us as active managers to outperform, because you've got this rule that effectively continuously sell the shares that start to do badly and buy the shares that start to do well. And that's a very, very powerful rule. And it's difficult to outperform over the long term. So short term, no. Long term, maybe yes.
All right. Well, as we're talking about companies like the Magnificent Seven, there's a very interesting question here on monopolies and duopolies. The viewer says, since I left school a few years ago, I've been creating a portfolio of mostly US-listed companies. In my portfolio, I try and find companies that are somewhat monopolies or duopolies. I have the following in my portfolio. So Visa, MasterCard, Microsoft, Alphabet, S&P Global, ASML, and Netflix. Not a complete monopoly, but close enough in my opinion. So the viewer goes on to say, now that the US markets are difficult to find obvious great deals in, I have shifted my looking to the JSE, and on the JSE I'm having a very hard time trying to find anything somewhat close to a monopoly. I'd love to hear your view on companies you would consider as monopolies, or companies that have a very high barrier to entry that it almost doesn't make sense to compete with. Very, very interesting question. So the viewer has found some sort of monopolies, duopolies, I guess leaders in their industries in the US, but now looking inwards to the JSE. Roy, firstly, what do you make of this thinking of looking for a monopoly or duopolies for your portfolio?
It's an interesting way of thinking, because typically when you're thinking about that, you're basically saying that that one player has access to the entire profit pool of the industry and is able to set prices, because that's very critical. If you can't set prices, it's quite pointless. So no, it's not a bad idea. I mean, because a competitive advantage can confirm monopoly-like status in an industry, and that's what the Magnificent Seven have been. In South Africa, what you have is regulatory monopolies, like the telcos, for instance. If you don't have spectrum or a license, you're not going to play. The big mining companies, like the platinum companies, you're not going to play if you don't have a license. Either that license is a regulatory monopoly. Sasol is another one. Those are the sorts of companies that I would say are close to monopolies in our market here. I mean, unfortunately, we don't have those that are technological monopolies like the Magnificent Seven. Although you could look at Naspers or Naspers process for a similar sort of thing. But yeah, an interesting way to think, I must say.
I mean, it's also quite interesting because as Roy mentioned, some of these kind of companies that are close to being monopolies, duopoly, we have not seen the returns in them that we have seen in the US monopolies and duopolies. So just your thinking in terms of looking inwards for those kinds of companies in the JSE and really how successful you could get, JP.
Yes, again, Roy is spot on when he refers to the regulated monopolies. So in South Africa, for instance, the telcos, you have two main mobile operators, maybe a third and a fourth weak player if you think about Telco Mobile and Cell C. But it's not as if you see monopoly type profits being generated by MTN and Vodacom because of that regulation. Secondly, you probably need a country with a regulatory framework which is quite laissez-faire. They don't really care. They want capitalism to run riot. Even when it gets a bit too much, they still see the benefits of that being outweighing the negatives of capitalism maybe going too far. While our country has got stricter rules, and through the Competition Commission, we normally nip that in the bud and we try to enhance competition, which isn't always great from a shareholder perspective. Sometimes you wouldn't mind if there are more monopolies out there that can just keep on increasing prices. It normally leads to more dividends and more profits for shareholders. But I understand also there's also a public interest in terms of making sure that no companies can gorge their customers when it comes to price increases. So bottom line in South Africa, not really a lot of these. If you think a bit wider, you know, a company like Eskom, a company like Transnet, they are monopolies, but they are loss-making because they, even though they're monopolies, you don't have the profit incentive, and you have terrible governance, and you have questionable management, and a lot of corruption and inefficiency. So yes, the viewer is thinking about it the right way, but I would struggle to think of any South African company which would tick the boxes. So if you want to invest in these monopolies and duopolies, the US is probably your main market, and you can pick up a few others in other markets outside of South Africa.
Very, very interesting question and insights there. Let's move on to other questions. City Lodge. Should I sell or hold on to City Lodge? I paid about R4.25 a share. Where is it at this point? I do know that I don't think we have the graphs up yet. But buying it at R4.25, thinking if they should hold or sell. But actually, there seems to be a lot of selling on City Lodge, and they did release their results, I think, last week. And yeah, it seems that investors didn't really take the numbers so well. Roy, City Lodge?
Look, City Lodge is you could call it a monopoly in a certain way, that it's a high fixed cost business that you build, and and what you do is you wait for the capacity to be used up. And as that capacity gets used up, if other people aren't expanding capacity, then your ability to price increases. So like when you look at whether it's the Western Cape or Gauteng, you haven't seen a lot of building of hotels recently. I mean, since 2010 World Cup. And what has happened is the hotels in existence have been at very low occupancies because of the economic situation, but these occupancies are rising. And as they rise, because there are no new competitors coming into the market, then the pricing power pushes to the proprietors, to the people who run these hotels. Now, City Lodge's problem is they're mostly Gauteng based. They're more inland than coastal. So the other hotel operators who've been coastal have benefited from rising tourism and everything. City Lodge has been waiting for business activity inland to pick up, and that hasn't quite been happening. But now you see things like the G20 coming in, and a couple of other things that may actually help pick up this capacity utilization. And in my mind, over time, they should be able to get that pricing power and be able to up their returns. So I think with all of these things, patience is incredibly important. The company is well run, solid operators, long experience, and you know that it's been more a macro thing that has led them to underperform, and not so much a poor strategy or anything of the sort.
Yeah.
So I think it's just a matter of time.
Yeah.
Time and an improving economic growth.
I don't know, but it just seems like investors are also just getting impatient with City Lodge, JP.
Well, it's flatline. So maybe if investors were impatient, you would see it drop even further. But since they did that huge rights issue to pay for the guaranteed BE deal that went wrong, 4 or 5 years ago, the share price has gone exactly sideways, and the profitability and the operating performance has gone exactly sideways. And while there haven't been building of new hotels from listed players, there have been a few private players. I can think of the Capital Group, for instance, which is a very innovative model,
yeah,
where people can effectively, individuals can buy a hotel room, and you can get a part of the proceeds as that hotel room is then occupied in the Capital Group hotels. And that type of capital being employed by individuals means that maybe the profitability is not as high as a corporate would seek. And that has put a dampener on a lot of the hotel industry. If you compare City Lodge also to Southern Sun, as Roy has correctly said, at the coast, which is where Southern Sun is more exposed, you've seen a lot of tourism pick up, but the business traveler, which is more aligned with what City Lodge clientele want to do, they want not, you don't go to City Lodge necessarily for the entertainment. They aren't really traveling as much, or the traveling hasn't picked up as much as the tourism spend has picked up. So there are a few headwinds for City Lodge, and I really hope they can get it right. I agree with Roy. I think it'll just take time, but as we wait, it'll probably flatline and continue to flatline until something like that happens.
All right. JP, here's one for you. Let's see if you can answer this one. How safe or unsafe are dual-listed shares on the JSE, which have a primary listing outside of South Africa, mainly on the London Stock Exchange, from the EWC legislation passed? I don't know anything about that, JP. Do you?
Wow. So when it comes to the Expropriation Act, I mean, all property basically is under the same legislation. However, if you read about the checks and balances and the fact that the court must be involved in all of that, I'm not having sleepless nights about expropriation without compensation. I think it'll be very rare to see a case like that. You can't really abandon a share. So I can't see any court saying that, oh, you've abandoned your share so the state can take it for nil compensation. I don't see that happening. When it comes to the nature of dual listed shares, there are two registers. Even though a share is dual listed, you have a South African register and, say, a London Stock Exchange register. So the South African shares are South African assets, and technically it can be confiscated. Let's say, for instance, your shares are the proceeds of crime. The authorities are in a position to attach your shares, even though they're dual listed, because they're on the SA share register, and you can lose your shares just like you can lose your cash in the bank in a South African bank account if it's proven to be the proceeds of crime and it is forfeited to the state.
All right. Well, another question here, Roy. This one is for you. Let me see if I can get to it. Stock pick for a tax-free savings account. We're actually just talking about it off air, and that is mainly for ETFs, right, Roy?
Yes. My understanding is that tax-free savings accounts do not allow you to invest in directly in stocks. It's collective investment vehicles, ETFs, and I suppose some approved unit trusts as well. But not, I don't think you can put in a stock.
Yeah. All right. Well, let's get to another very interesting question. What do you think about the special dividend declared by Implats? Was it a good move, JP? That was last week.
Yeah, I think it's mostly to the benefit of Anglo-American. They obviously want to suck out some cash before they lose control and unbundle Implats shares. And I would say that this special dividend declaration is more at the behest of the controlling shareholder than anything else. So I don't necessarily think that it's a great idea for Implats. At this point in time, with where platinum group metal prices are, I would much prefer a miner to have excess cash and even think about buying distressed assets if it comes that way versus paying out its excess cash as a dividend. I don't think necessarily it's the greatest idea.
All right. Well, another question coming through for you, Roy. Why the punishment of Reunert? I was actually looking at that chart, and it has been on a downward trend since November last year. It just has not gotten a break.
Remember, Reunert is one of those businesses that really benefited from load shedding through batteries, panels, and all of that. So I imagine that investors must have pushed the price up significantly, believing this was going to go on for a long time. But clearly that came to an abrupt halt. Strangely enough, with load shedding coming back now, maybe it comes back into favor. But I think it's a bit unfair. I think it's a nicely diversified business.
Yeah.
It's well managed. They've got a strong defense business. And as you can see what's happening in the rest of the world, defense shares in Europe are rallying. They've got some good contracts into India and a variety of other places. They've got a nicely diversified business. It's very conservatively run. I think it's just become cheap. Not so much that they've underperformed or anything. I think the investors were overconfident and probably paid up too much for it. It has reset. It's probably trading now at a lower multiple than it's traded historically. And like I said, could be offering value.
Yeah, it's quite interesting. I mean, as Roy says, that it is a diversified business, so it's not just the business that does benefit from load shedding, even though maybe we could see a pickup now. But yeah, is it not? Yeah, is the sentiment maybe not misdirected or misplaced? If it is that reason behind it, JP?
Well, I was going to make this comment at the end on my stock pick, but I'll make the comment now, and that is that a lot of SA Inc. companies, a lot of shares exposed to the domestic economy, went up very strongly from more or less the election earlier last year to more or less the end of 2024, and have come down quite a bit since then. So they went up in a straight line, and many of them went up 50, 60, 70%. And somewhere between November, December, they reached a high and they've dropped 20, 30, sometimes even 40%. So the fact that it's almost every single SA Inc. stock that has shown this type of behavior tells me that it's very much sentiment driven. And that does create an opportunity, because if you can pick the SA Inc. shares that have dropped 20 or 30% and maybe weren't too expensive in the first place, but you don't think their profitability is going to drop that much, it's an opportunity. While some others might drop even more, if you look in the construction space, for instance, what's going on there, you know, some companies aren't seeing any benefit from what happened after the election, and their shares maybe has some more way to go to fall further. So I do think whether it's Reunert or other SA Inc. shares, there's an opportunity here for because of the fact that all of them are more or less down 20 to 30% over the last 3 months.
All right. Well, let's get into asset management, and where I'm going to give you Coronation and UJP91. Coronation, is it a good buy?
So Coronation will give you a solid dividend yield. I think it's somewhere like 10% right now. It's a business with heritage in South Africa, but the thing about that industry is it's really changing. The scope for a pure equity asset manager, I think, is diminishing. And what these companies are becoming is more platforms, which are driven by all of these product providers and advice and all of these things. You become a one-stop shop. So you're not just one asset manager. You provide a variety of services around advice, wealth management, retirement, and all of that. And I think when you look at also what's happened in SA is, as a result of Reg 28, a lot of money has gone offshore. And a lot of local capital allocators would rather allocate their offshore money to international managers rather than local managers. So Coronation's playing in a compressing space.
Okay.
That's consolidating, that doesn't have much growth in it, but it's largely owned by its own staff. They will always pay a solid dividend, so you as a shareholder can partake in that. It's not nowhere near being expensive from that perspective. It just will not grow earnings really fast.
What about 91? And the question goes, is the share price, why is the share price falling despite good metrics? Is there concern regarding the UK fund management market? JP?
Short answer is yes. So whether it's the UK fund management market or globally, 91 is a global asset manager. I mentioned earlier in the show that active asset managers have been finding it very tough the last few years. And that typically happens when the best performing shares are also some of the biggest companies around, because that's what drives an index. And that's exactly what has been the case, specifically in the US market. So all active asset managers have been under pressure the last few years. The solution for many of them is to consolidate, to make acquisitions. Now, I can remember when Roy had a red background, I think it was a year or two ago. Now he has a blue background. Maybe in a few months he'll have a brown background. And that's exactly what's happening as you have this Pac-Man dynamic of the one company eating the other, which just ate the previous one, a few months ago. So 91 is trying to bulk up, to make acquisitions, sometimes acquiring companies who made acquisitions themselves. And that could help. But basically what we need is this dynamic of the indices being driven by these large, very well-performing shares to change. And then for the 91 portfolio managers to make good stock and fixed income picks and outperform their benchmarks. Then 91 will do well. So the metrics, yes, the metrics are decent, but they are backward looking. The key is how these metrics of the company are going to change on a forward-looking basis. And that obviously no one knows, but you need to make a few assumptions regarding how you see the future play out.
Roy, don't worry, your background may change, but you remain unmoved. Let's get to your stock picks. What are you picking today, Roy?
Yes, so Bidcorp reports tomorrow, and it's one of those easy to ignore stocks. It's a big stock. It's only listed here in South Africa, but it only has about 5% of its earnings from South Africa. It's a global business, deals in the world of the shift from cooking at home to eating out. And because a large component of its business is in the developed world, it's done really well. They tend to have a pretty lazy balance sheet, which allows them to make acquisitions. They're very operationally driven, improving their businesses from the bottom up. So their margin expansion is not so cyclical. It's actually structural as they add more and more products in the countries. And in the countries they're in, they typically tend to be top 1, 2, or 3 player in a minimal player market. So I think at current levels, it looks like it offers value. It's not expensive at all. And like I said, it's easy to ignore it because it never has these violent swings about its share price or its earnings.
And it's coming out with the results this week, right? Roy?
Yeah.
Yeah, okay, cool. We're looking forward to those.
Tomorrow.
JP, let us get to your stock pick for today.
I'm picking a company listed on the JSE, AVI. So they do a little bit of fashion and clothing and footwear, but predominantly food. So if you like your coffee or your tea or your biscuits or your snacks, your potato chips, AVI is a purveyor of these. It's not quite a monopoly, but it does have large market shares in the specific food products that it manufactures and sells. Like so many SA Inc. shares, it did tremendously well between early last year and late 2024 after the election, and it's down quite significantly then. And I think that creates an opportunity because the company keeps on delivering solid financials, very good management team, very good history of capital allocation. They pay out special dividends whenever they have excess cash. So with a good management team at the helm, I don't think necessarily the business is worth so much less than the share price has fallen by over the last 3 months. A high quality company on the JSE, especially in a market globally where shares are expensive, I think it's a decent time to look for some opportunities on the JSE like AVI.
All right. Thank you so much for your time and for your analysis today, gents. Much appreciated. That is all for tonight's Stock Watch. Thanks to our guest, Pierre Verster from Protea Capital Management and Roy Mutooni from Sanlam Investments. Up next, The Close. Stay watching.